Geetha, give us a sense here right now of what jumped out at you most. Were you surprised by anything in here?
Yeah, so the couple of numbers that really kind of jumped out at me. One, I was looking at streaming losses. And remember, this was why they got so much of flack last quarter when they reported 1.5 billion in streaming losses. We were expecting about 1.25 billion for this quarter. They came in at just over 1 billion. So again, a big beat there in my view. And then you look at the parks numbers, absolutely a resounding success there. So we were expecting about 2.5, 2.6 billion in operating income. They came in at well over 3 billion. And you look at the margin there on that business, almost close to 35%. So, if the buzzword on Wall Street right now is profitability, I can tell you Bob Iger is already delivering results.
How much of that can be credited to Bob Iger, though? Because, yes, he came back, but some of the changes had already been in place.
Oh, absolutely. But I think it's all about, so while this report obviously is about numbers, I think a lot of it is going to also be about strategic direction and, him setting the tone, him kind of maybe resetting some of the subscriber targets out there. And we already saw that. If you just kind of look at the subscriber numbers, I mean, this is a company that has posted Disney Plus subscriber gains, 10, 15 million every quarter. This quarter, they actually lost subscribers. And again, investors not really caring about that at all, because at the end of the day, it's all about the bottom line. And as long as he can articulate a strategy, a strategic vision for this company where you have profitability and you have sustained earnings growth, I think, investors are going to cheer that.
I really want to hear him articulate that. And I'm curious, Geetha, based on your own research and your just own insights here, how much of a shift, if at all, do you expect out of this? Is this just going to be basically staying the course and just making some improvements around the edges? Or do you expect to see a material shift in certain areas of the business under Iger?
I think, we're definitely expecting a lot more austerity. So we already know that there are, quite a lot of content, like there's a lot of so if you're looking at the media business, it's content costs and non-content costs. Now, in terms of content costs, they are being pretty disciplined. So they're going to stay in that 30 billion zip code. They are trying to, cut costs as much as possible. But remember, a lot of these are already kind of spoken for. When they're sports rights, there's not a whole lot of flexibility that they have there. So now the big area that we're kind of looking at is non-content costs. And remember, non-content costs for Disney is almost 30% of revenue. That's way above some of their peers. If you look at Netflix, it's only about 20% of their revenue. So they obviously have a lot of room there to kind of cut costs. And that's kind of where we look for Bob Iger to really come in there and provide some good strategic direction.
Cost cuts are certainly a catalyst for the stock, and it's what someone like Nelson Peltz wants to see. But Bob Iger is known for transforming Disney, for, like you said, articulating strategies, thinking big in terms of what this company can achieve. What is the next growth lever that he can pull?
Yeah, so, there are really so many, loose ends right now for Disney, right? And a lot of it has to do with the asset mix. So I think the two big questions right now on everybody's mind is what happens with ESPN? Are they looking to kind of spin off ESPN? The writing is on the wall when it comes to the future of TV networks. We know it's in secular decline. We know ESPN is going to be, losing, or there's going to be a decline in affiliate fees this year, even as sports costs go up. So kind of what is the strategy there? Are they just going to run the course? Are they going to make a bigger push into streaming with ESPN? And then again, what is the strategic direction with Hulu? Are they, we know that they have to buy out Comcast's stake, which is about 33%. Are they going to expedite that? But that does involve them paying about $9 to $10 billion. So again, those two are, I think, the topmost questions right now. Apart from, of course, will they actually walk back their subscriber targets? If the focus right now is on profitability, it's not on subscriber acquisition anymore. It's on subscriber retention. They already seem to have a really good plan in place, and maybe it makes sense at this point to walk back those subscriber targets and instead kind of articulate a better or a quicker path to profitability.